Rajat Jain, Chief Investment Officer with Principal Asset Management joins us. Rajat, we are off to a shaky start. The midcap index is down for the 9th day on the trot now. Why are midcap stocks feeling the heat?
No, I think there's a bit of collateral damage here as well. I think when there's a risk off, people just want, there's a flight to safety, so everything. In a way, so what happens like in such a scenario, actually the baby gets thrown out with the bath water, as it were. So you have all kind of mid-cap names. Some of them actually were expensive and they didn't have great business models, but equally there were a fair number of companies which had decent promoters, good business models, and actually are, as a result of this carnage, if you can call it that, are available at now fair valuations. So mid-cap is nothing to do with the companies per se, partly to do with the companies, partly some because of the environment. So like they become collateral damage.
So what are you doing in this kind of a market? I mean, we all know that the sentiment is bad. Are you a buyer of this poor sentiment, or this is just the beginning of a decline and a prolonged decline because funding issues will be a problem, economic growth, and because of NBFCs, the growth for autos and other sectors will also be easy. So are we staring at an acute slowdown because of funding and liquidity issues?
I don't think so. Are we seeing an acute slowdown? See, I mean, if we just step back a bit, what happened in September with ILFS issue clearly had an impact of our October-December quarter, and we've seen that in the numbers from the NBFCs that have come out in terms of growth numbers. AUM growth has been quite tepid. This latest, what happened last couple of days, related to Z, isn't really an NBFC funding issue in some ways, though it could, for the near term, slightly could slow down flows into credit mutual funds. But NBFCs are funded not only by mutual funds, whom certainly, I mean, they do take CPs, but we already seen NBFC reducing reliance on CPs. I think right from September onwards, they have been cutting down. They're trying to rebalance their liability profile, go for more long-term liabilities, raising bonds and so on and so forth. So yes, will this, to answer your question, will this lack of liquidity something that's going to prevail over the long term and going to impact the GDP growth? We don't think so. Clearly 1 or 2 quarters it is going to be a time of churn, but I don't think this will have permanent long lasting damage in terms of liquidity in the economy.
Okay, so in this weakness, Rajat, do you sense that the cream needs to be bought, Bajaj Finance, whenever this NBFC crisis, hopefully it should not balloon much further from here? Stocks like these, you know, the A-rung companies should be bought, or do you sense that when the revival comes in, when these stocks and clusters recover, when the news fades away, there would be a sectoral churn, or rather there would be a stock churn within the sector which could happen? Or do you think the leaders will remain the leaders?
Yeah, I mean, like without getting into specific names, but clearly I think, as I said, because in this environment when everything is punished, I mean, I don't like, or the market doesn't seem to like NBFCs for some reason at this point of time, so all of them are taking a beating. In such a scenario, what will happen is, I mean, there are good companies which are say AAA or AA or AA plus rated, and they have good business model. I think easier for them to raise money, and we always have said and we believe that NBFC, there's a raison d'etre for NBFCs to exist. I mean, their cost of operations is lower, their access and understanding of the ultimate customers is better, their turnaround time, all of that. So yes, so the business case for NBFCs remains, but the liability, which is the raw material for the NBFCs or any finance business, is a challenge at this point of time. Now, will that be permanent? We don't think so. And clearly the better run companies, I mean the bigger, the better companies, I think they will have less of a problem raising liabilities. So at some point of time NBFCs will look attractive, but I think not for the next 1 or 2 quarters. I think we should be cautious about NBFCs simply because of the environment is not conducive towards them. But will they be, you know, permanent casualties? We don't think so. But the larger companies, the well-run companies, I think should come back.
Right. I just want to mark Z and some other group of names where there were genuine margin concerns. Z, Dish TV, SL, just for the benefit of our viewers, where that stock or where some of those group names have got settled right now. Praj, again, blowout set of numbers. Rajat, the crowded and the cozy trade for last 3 months has been long corporate banks. Are you of the view that there is money to be made in an ICICI Bank, Axis Bank or Federal Bank, or right now markets are positioned for a recovery, but the recovery is not going to be a V-shaped recovery and we could be in for some early hiccups?
Yeah, I think the 2 points that you made, it's a crowded trade. Yes, I think a lot of, because lack of alternatives, and clearly this is one space where you are seeing improvement. Would it be a V-shaped improvement? Unlikely. I mean, the GDP is not is looking better, but the capital spending and so on is not taking off yet. However, having said that, the asset quality resolution issues that we all know, I mean, they are sort of probably getting past them. We seem to be getting over the hump in terms of bad debt creation, incremental bad debt creation, except the only caveat to that I think would be power sector. We should be slightly more, probably on the power sector we could have some concerns in the near term, but outside of that we are not seeing fresh bad debt creation. Resolution is on the way, and they are capitalized. I mean, capital is the raw material for growth, so they have those things available. So clearly, I mean, you have growth, you have asset quality looking better, NBFC competition is weaker, so all those things are tailwinds for them. So even though it is a slightly crowded trade, a lot of people have gotten into that simply because the fundamentals are so strong. I still think it's a place to be.
I just wanted to understand, where this entire auto weakness is going, and I don't want you to comment on individual stocks, but across the board you've seen weakness, be it iShares numbers, Maruti for that matter, such a disappointment, and this after you already saw that coming. The 3-month trend, the dispatch figures already told you that it's going to be weak. Or for that matter, even if I look at some of the rural plays like in Escorts, and the FY20 outlook also remains uncertain according to players like Escorts because of factors such as high base, such as the monsoon. What is it that you foresee for the auto industry right now? Is revival anytime soon, or do you think they'll continue to be in a slump for some foreseeable future?
I think 2 parts to it. I think the two-wheelers clearly see challenges in the near term. I think there were issues related to insurance, related to higher fuel prices, not so much for two-wheelers, but certainly insurance was something which was a bit of a dampener. NBFC's liquidity tightness did certainly impact auto sales, but even going forward, come April 1, 2019, the two-wheeler, because of the safety norms, ABS and all that, is going to increase the prices of two-wheelers there. So that's certainly something which we're going to be cautious about. But as we roll into April 1, 2020, we have the new BS6 norms rolling out. So 2 things, I think there could be some pre-buying. So tactically, I think it could be interesting towards the end of the year. You see probably volume growth ahead of the BS6 rolled out next year. But then again, the prices and the impact on demand going forward could be an issue. So I think the multiple events which are not entirely in their control in terms of rising prices for different regulatory reasons is something that's going to impact them. So I think a tactical trade towards the end of the year, if you want to play the buying and the pre-buying as it were. But having said that, if we just step back a bit, I think say for example in India, if you just forget the next 1 year or so, if you look at a 2 or 3 year view, say stocks in the passenger vehicle segment, for example, if you have a company which is well run and has corrected, is dominant and so on, so I think they will become attractive at some point of time. But this year is going to be a challenging year. But having said that, should we not have autos for the 2 or 3 year horizon? I won't agree with that. But this year is going to be a challenging year.
Yes, this year is going to be a challenging year. Rajat, so how do you manage the challenge? How are you looking at your asset allocation strategy, in order to mitigate the risk that comes with the challenges?
Yeah, in terms of equity portfolios, idea is to be, test your assumptions in terms of companies where you likely see earnings growth happening, You don't want to be caught off guard with companies which are not able to deliver earnings for different reasons. So A, test your assumptions. Be well. Second is be well diversified. Be aware of the kind of bets that you have in your portfolio, and set stocks like, for example, sectors like IT, for example. I mean, IT where we have a neutral, or in some portfolios a slightly overweight. I think in this sort of a scenario, it's a good place to be in terms of global volatility. I mean, we still, our base case is that the US does slow down, but we don't see a recession this year. So we still see spending on IT remaining flat, and large cap companies continue to do reasonably well, and they have corrected, and some of the mid cap companies have corrected as well. So if you're diversified, you have sectors which we still think are going to deliver earnings, reasonable earnings growth. I think all of that is going to help you preserve your capital this year, but it's going to be a very challenging. It's going to be a lot of volatility in it. But I think what will happen is, in bad days when the stocks are down 10, 15, 20%, and then you can gradually build your portfolio. So I think over the next 2 or 3 years you'll make good returns in equity. So this year is going to be a tough year.
So what is the best and the worst case scenario, Rajat, that you're penciling in? We already just about made it to 11K and receded from there. What's the high and the low of the Nifty, if you may have an internal target, or the Sensex?
You know, it's difficult. I mean, we don't really have those. It's difficult to say about the market, because you know what will happen close to elections. Because we all know, I mean, we've been in the markets, that over the long term these really are events which tend to have little impact on the fundamentals of the market, but 1 or 2 quarters they can cause enormous swings. I mean, supposing you get a result that the markets tend to like, for whatever reason, the markets could be up substantially, and likewise if you get a result, or the electoral result, which the markets don't tend to like, I mean, the markets could be down. So these are what will happen, but will there be permanent damages? Though you could have a sharp fall in the market, and the market recovers some of that, and likewise the market goes up sharply and then ultimately decides that earnings is what matter. So I think you'll see a lot of volatility close to the elections. So it won't be a bad idea to, you know, do something like a systematic investing this year, so that you don't really get caught one way or the other, and either, you know, buying the highs or when the volatility is there in the market. So it's good to have a system this year.
Just, why are FMCG sales holding on? There is a slowdown in the entire auto space. There is a slowdown which is clearly visible in the agrarian economy. Farmers are in a distress. That's what the political pundits are claiming. Yet if I look at what... Is my voice reaching you, Rajat? Hello? Is my voice reaching you, Rajat? I think my director has also forgotten to give me cues. Okay, I think the line is disconnected. 283 rupees for State Bank of India. ICICI Bank also is making a comeback. Bajaj Finance has already made a comeback. So markets are telling you that yesterday's panic, which was there in across the board NBFCs, now seems to be settling down. Today Bajaj Finance also will come out with numbers. But the first one to fall were some of the leverage names. The first one to come back essentially are some of the corporate banks. Rajat, auto sales are slowing down, there's agrarian stress, but yet FMCG companies, they surprise us. Why is that?
Nikunj, I'm sorry, I hear very, very faint. I think I can't hear you.
Should I give it a shot? Rajat, Nikunj just wanted to know as to why amongst the entire cluster FMCG sales continue to hold out.
Oh, okay. I think because like they're probably like smaller ticket items. Those are not something that tend to be bought on credit, so no NBFC issues have any impact on them. And there is anyway a long-term trend towards premiumization, more branded goods. I think that sort of remains in place. So I think all of that, and the economy still it's not doing badly at all. I mean, we are growing at 7.5%. Rural terms of trade, part of the rural economy is good. So all of that, I think it's what's helping NBF. I mean, I think FMCG companies.
Yeah, so that's with the consumption story. Do you think that, aside of consumption, the investment-led themes are also going to get a leg up in the wake or, in the time between the budget and the election, which is a good, like, 4-5 months gap, and you would want to kind of scale up on those investment-led themes, whether it's to do with the real estate or engineering companies, the construction infrastructure space, so to speak?
I mean, playing, okay, two things. I think, okay, we are playing, say, for example, the capital expenditure theme. So things like, say, companies which are focused on railway capex, for example. If you look back last 6, 7, 8 years, the compounded growth rate in railway capex has been quite tremendous, and we still see a lot of spend on that continue. So that's something that we like. We still are not seeing great private sector capex. So anecdotal data is there. I mean, a lot of people have announced brownfield capex. What we are not seeing are those traditional, say, power and those kind of capex happening. But companies are announcing medium-term brownfield capex. But I think railways and things of that nature. I mean, we have always seen work on solar, which has been a lot of, actually one of the largest capex areas, like metros and irrigation. Those kind of works has been happening, and some of that's going to continue. So it's not a near-term trade, but I think it's certainly a trade over next it's companies to hold for next 2 to 3 to 4 years. But we still not seeing strong private sector capex. So not playing those kind of companies, but more on construction and so on, and cement as an ancillary. I think cement is something that has not had in terms of price, we've not seen pricing growth come back this year. The volume growth remains strong, and for next 2 to 3 years, I think it's not a near-term trade that we're going to see, but what we're going to see is capacity creation is modest for next 2 to 3 years. Volume growth is going to be in the range of 8 to 10%, and as pricing growth comes moderately, I think you'll see growth in earnings coming for cement companies. So those are something that we look to play as a surrogate on the capital expenditure cycle.
Hey, Rajat, great having you on the show. Thanks so much for taking the time out. Good to speak with you as always.
Pleasure.